If you're looking to start selling covered calls, then you've come to the right place. Because in order to achieve the 3 to 6% monthly returns that are possible with a covered call portfolio, there are some factors you need to keep in mind that I don't really see a lot of other people talking about. So let's get into it. My name is Charlie, and on this channel I make videos about wealth building and achieving financial freedom so that you can free up your time to focus on the things that you truly care about. Now, like I said, it's very possible to achieve a consistent 3 to 6% return per month selling covered calls, which is about 42 to 100% over the course of a year, but most covered call writers don't achieve those type of returns. So it's not enough just to write covered calls, you also need to know how to pick the right stocks and how to set up your covered calls properly. So I've already talked about how covered calls work in my very first video on this channel, and I'll link that below in case you haven't seen it, but I'll just give a quick summary here. And for those of you that already know all of the basics, feel free to skip ahead to the part of the video that you are interested in using the timestamps in the description below. Now, essentially the whole idea behind selling covered calls is to use the stocks that you already own to generate additional income on a consistent basis. So in order to sell a covered call, you first need to own 100 shares of a single stock. Then you're able to sell a call against those shares, which in English just means that you're selling the right for someone else to buy your 100 shares away from you if those shares hit a certain price by a certain date. And by selling those rights, you collect a small amount of money known as a premium. So as an example, let's say that on Monday, January 4th, we buy 100 shares of stock XYZ at $100 per share. Then we sell the January 18th 102 strike call. And for selling this call, we collect a premium of say $120. Now, if the stock ends up above $102 per share by the end of the day on January 8th, when the call expires, we have to sell our shares at $102. But if the stock ends up below $102 per share by the end of the day on January 8th, we keep our shares and we can just go ahead and sell another covered call the next week. And of course, in both cases, you always keep that initial premium that you brought in. So essentially the main downside of covered calls is that if your stock does rise very quickly after you've sold a call against it, you still have to sell your shares at the agreed upon price, so you could potentially miss out on some of the rise in that stock. But you'll find that if you set up your covered calls in the way that I'm about to discuss in this video, then the premiums you collect will far outweigh any gains you miss out on. So before you actually sell your first covered call, there are basically 3 things you need to consider. Which stock to choose, which call to sell, meaning which strike price and expiration date to choose, and then finally how your covered call stocks should fit into your portfolio. So when it comes to the stocks you should choose, this is where I see that most people make mistakes, because you want to of course pick stocks that have a tendency to rise, but you also want stocks with some level of volatility, because the more volatile the stock, the higher the premiums will be. So personally, I like to pick stocks that are upward trending over both the last 5 years and 3 months, have increasing top line revenue on a year-over-year basis, and that I believe in and expect to rise over the long term. Then from there, I like most of my stocks to pay a dividend and be included in the Dow Jones Industrial Average, or at least the S&P 500. So a lot of times I'll see people pick stocks like AT&T or GE, which you might think of as solid companies, but they're downward trending over the last 5 years, and they're also not volatile enough to yield very high covered call premiums. Part of the benefit of selling covered calls is that you can bring in some capital gains from the stock rising alongside the premiums you're bringing in. So if a stock has a tendency to fall rather than rise, you won't be bringing in those capital gains. And even a stock like Johnson & Johnson, which does technically meet all of my criteria, is one that I'll often see people choosing, but let me show you why I don't like it for covered calls. If we look at the option chain, the premiums aren't actually that high because there's not a lot of volatility to the upside in this stock, essentially just meaning that it doesn't tend to rise very quickly. So you might bring in around 0.5% per week selling covered calls, but that's pretty minuscule compared to a stock like Nike, where you can bring in upwards of 2% per week. And Nike is in a much stronger upward trend, so if we look at the 5-year chart of Nike, then compare that back to the 5-year chart of Johnson & Johnson, it's pretty clear that Nike is the better stock to own. And some might say,
well, of course you can say that in hindsight, but you can't predict what's going to happen in the future.
And they would be right, but past performance does provide clues as to what we can expect to happen in the future. So if nothing changes with the fundamentals of the company, why would you expect the performance of the stock to change? I'd be willing to bet that over the next 5 years, Johnson & Johnson will perform similarly to how it's performed over the last 5 years. And I'd expect Nike to perform similarly to how it's performed over the last 5 years. Again, as long as nothing changes fundamentally with the companies. And the same goes for the other Dow stocks I like at the moment, like Apple, Microsoft, and Visa, and even the non-Dow components I like, for example, AMD, Chewy.com, MasterCard, PayPal, and Square. So now that you've chosen your stocks, let's talk about which call you should actually sell. And it does depend a lot on the current market conditions and the behavior of the specific stock you chose, but generally you'll want to sell your call a few strikes out of the money, meaning a few strike prices higher than the current price of the stock. That way you leave yourself with some potential to bring in capital gains as the stock rises. So if you're trading a stock that tends to rise quickly, you may want to sell your calls further out of the money. For example, with stocks like PayPal and Square, I might sell a call up to about $10 out of the money. But if a stock is relatively neutral, then you may want to sell your calls just slightly out of the money. For example, with stocks like Microsoft and Nike, I may only sell my calls about $1 to $3 out of the money. Now, as far as the expiration date, you would in theory want to sell mostly 1 week calls in order to maximize the premiums that you're bringing in. Meaning that if you're selling a covered call on a Monday, for example, you'll choose the expiration date of that same Friday, just 5 trading days out. So that's usually what I prefer to do, especially when the market is rising, but there's definitely a time and a place for longer dated calls as well. The advantage of longer dated calls is essentially just that you're guaranteeing yourself a bigger premium up front. So for example, just to make up some numbers, the premium you bring in for selling a 4-week call might be $500, whereas the premium for selling a 1-week call at the same strike price might be $200. So it doesn't take a genius to see that if you sold 4 consecutive 1-week calls, you'd bring in more total premium than if you had sold a single 4-week call, at least on paper. But the difference is that 4-week premium is guaranteed up front, whereas with the 1-week premiums, you'd need that stock to either rise or remain neutral during that entire 4-week period in order to keep collecting those high premiums. With that said though, the furthest out I'd really go is about 5 weeks. So in a neutral to declining market, I sell calls about 2 to 5 weeks out, and in a rising market, I sell calls about 1 to 2 weeks out. Now, the last factor, which is often overlooked in my opinion, is how covered calls should fit in with your overall portfolio. Because as we know, with covered calls, you're limiting your upside to some degree, so you don't want your entire portfolio to consist of covered call stocks. So personally, I allocate about 75% of my portfolio to covered call stocks. Then the remaining 25% goes to long-term holds, and sometimes a small number of leaps options as well. But also, whenever I sell a covered call on a stock, I generally buy 120 or 125 shares rather than just the 100 required for the covered call, so that I can take advantage of a little bit of that additional upside. And since you should only sell covered calls on stocks that you expect to rise over the long term, it's always a good idea to hold some extra shares on the side in case the stock does rise above your strike price. So I have accounts with both Robinhood and TD Ameritrade, and I'm going to walk you through the process of selling covered calls on each just to show you a couple of different perspectives with 2 different stocks and 2 different brokerages. But regardless of which brokerage you use, the process will essentially be the same. It's really just the visual interface that will be different. So I'm going to start with TD Ameritrade, and I'm on the Thinkorswim app, which is basically just the trading platform that TD Ameritrade uses. So the covered call I'm going to sell here is on Chewy, and I actually already own 120 shares, and I have 1 covered call sold against those shares. So I've got my 20 shares on the side, and I'm just gonna buy another 100 to sell another covered call. So I'll just go ahead and buy 100 shares at the market price. So then I'm gonna go back to Chewy and pull up the option chain. And since this stock has been in a pretty strong upward trend lately, I'm just gonna sell a 1-week call. So today is Monday, December 14th as I'm filming this, and I'm gonna pick the December 18th expiration date. So I'll scroll down to the out of the money calls, and then it looks like the only options I have for out of the money calls are the $85 strike, and then it goes all the way up to the $90 strike. So I'm gonna pick the 85 strike, just barely out of the money. Click sell, 1 call. We'll just do a market order in this case, then hit send. And there we go. So it got filled. I brought in a premium of $2.09, which of course, since this is done in 100 share increments, that's actually $209. So I bought the shares for $84.36. So if we do the math here, the premium I brought in was $2.09 divided by $84.36 is about a 2.5% return for a 1-week trade. So that's definitely pretty good. Of course, Chewy is a slightly more volatile stock. It doesn't pay a dividend. It's not a member of the Dow Jones Industrial Average. So I wouldn't recommend selling all of your covered calls on stocks like this, but it's nice to have those more volatile stocks in there to bring in some bigger premiums. So now I'm gonna open up Robinhood here, and we're gonna pretend that I'm gonna sell a covered call on Nike. I'm not actually gonna do it in this case because I don't really have the free cash available in this account right now, but we'll walk through the process as if we were going to do it. So you'd buy 100 shares of Nike just as you normally would, type in the quantity, and then submit that order. Then once you've got your 100 shares, you'll pull up Nike again, pretend we bought it around the $137.80 price, go to trade options, We'll do the December 18th strike price since Nike is also in a pretty strong upward trend. You want to make sure you hit sell and then call. And then usually I would either sell anywhere between the 138 to 140 strike call, depending on how much potential you think this stock has to rise over the next week. So in this case, I'll just split it down the middle, go with the 139 call, hit one contract, and then again review and submit that order. So for that trade, you'd bring in a premium of about $290. So again, let's calculate the returns on that. So $2.91 divided by that share price of $137.80. So that's about a 2.1% return. So even on a pretty stable Dow component like Nike here, you can bring in really good returns, and that still leaves us with about $120 worth of potential capital gains if the stock rises over the next week. So now that you know how to sell covered calls, if you want to learn some other strategies that I use in more neutral to declining markets, be sure to click that video in the bottom right corner of the screen. So I'll talk to you all in the next one.